As of May 2025, the global economy stands at a crossroads, supported by cautious optimism, but still navigating persistent trade tensions, inflation concerns, and limited policy flexibility. Here's a concise look at regional dynamics and key sector trends. United States growth and inflation. The U.S. economy contracted by 0.3% in Q1, mainly due to falling exports and inventory drawdowns. However, a 90-day tariff reduction on Chinese imports has improved sentiment. Full-year GDP is now projected at 1.5%, double earlier expectations, but still below 2024 levels. Consumer spending is soft, and hiring has slowed. Policy outlook. Tariffs have added about 0.3 percentage points to goods inflation. The Federal Reserve is holding rates steady at 4.25% to 4.5%, balancing inflation concerns with limited fiscal space. While tax cuts and deregulation may boost business confidence in the second half, risks from inflation and trade re-escalation persist. U.S. technology sector. Moderating momentum, long-term strength. After a strong 2024, growth in tech has moderated. Hardware and semiconductor demand is slowing, but enterprise software, AI infrastructure, and cloud investment remain robust. Capital expenditure is projected to rise 8% in 2025, with a focus on productivity-driven innovation. Valuation and positioning. Valuations have eased but remain above average. The sector continues to offer structural opportunities, particularly in cybersecurity, automation, and generative AI. Selective exposure remains key, focusing on profitable leaders with strong balance sheets. Eurozone growth trends. Q1 growth came in at 0.3 to 0.4%, marking 5 consecutive quarters of expansion. Easing inflation and Germany's fiscal policy helped, but trade uncertainty and U.S. tariffs continue to pressure exports. S&P now expects 2025 growth at just 0.9%. Monetary and fiscal policy. Inflation is projected to fall to 2.1% this year, near the ECB's target. A final rate cut may come by June, with hikes possible by late 2026 as stimulus gains traction. Growth remains fragile and reliant on stable demand. China. Resilient exports, weak domestic demand. China grew 5.4% in Q1, driven by strong exports to the EU and ASEAN. However, domestic demand remains soft, restrained by high savings, youth unemployment, and low consumer confidence. Policy challenges. Despite subsidies, household spending has shown limited improvement. Core inflation is subdued, signaling continued deflationary pressures. Full-year growth is expected around 5%, but policy execution and global trade dynamics will be decisive. Emerging markets. Divergent paths. Emerging markets show mixed performance. Export-oriented economies like India, Mexico, and Indonesia benefit from global demand and sound balances, while frontier markets face pressure from U.S. rates and dollar strength. Outlook. EM inflation is easing, allowing some monetary loosening. Growth forecasts range from 3% to 5%, with infrastructure, trade realignment, and tech adoption driving momentum. Selective positioning is crucial, especially in reform-driven economies. Global recovery continues, but unevenly. While tariff adjustments and fiscal policy offer support, inflation and trade uncertainty remain prominent risks. For investors, the second half of 2025 calls for selectivity, focused on structural winners in technology and resilient emerging markets.